Hi, this is Lara at Elliott Wave Stock Market with your end of the week analysis for the trading week ending Friday the 3rd of November. The target remains the same, 2616 to 2617. The upward trend remains intact. Assume it does remain intact while price remains within the green channel on the hourly chart. However, at the end of this week, there's now some weakness in market breadth, pointing to a possible pullback developing here or very soon. Let's do the Elliott wave analysis first and then classic analysis second and see which of my two hourly charts has more support from classic analysis. My Elliott wave count expects that a big cycle degree fourth wave ended here in early 2016, and that a cycle degree fifth wave upward begins here for cycle wave 5. This is a fifth wave to end a super cycle fifth wave to possibly end a grand super cycle first wave. So this wave count, when this whole structure for grand super cycle 1 is complete, we'll be expecting a huge trend change and a very large bear market to develop, but we are absolutely not there yet. And I think that the end of this bull market is at bare minimum 4 months away and probably more likely 1, 2 or maybe even 3 years away. The structure could take quite a while to complete. My target for now is 2926. My previous target at 2500 has been breached with further upward movement. That was where cycle wave 5 would have reached equality in length with cycle 1, and that was the most common Fibonacci ratio for a fifth wave to exhibit, so that was my target. But now that it's been breached, I'm using the next Fibonacci ratio in the sequence, where cycle 5 will reach 1.618 times the length of cycle 1 at 2926. Again, when we get up to that target, if the structure is incomplete or if price just keeps on going up through this next target, then I'll calculate the next Fibonacci ratio in the sequence, which would be for cycle 5 to reach 2.618, the length of cycle 1, and that would be a new higher target. So that's going to be my approach for target calculation for this upward movement. I think that's quite a logical approach. Cycle wave 5 may only subdivide as a 5-wave structure, so it can only either be an impulse or an ending diagonal. It's pretty obviously not a diagonal, it's unfolding as an impulse. When it's complete at the weekly and monthly chart level, it should have a fairly obvious 5-wave look to it at those time frames. In order to achieve a fairly obvious 5-wave look to it, its second and fourth waves to come at primary degree should be about even in duration, so that they have good proportion, and that's it's the proportion between second and fourth wave corrections which gives a wave count what we call the right look. And so when primary 3 is complete, I'll be expecting a multi-week or even multi-month pullback or consolidation for primary 4, so that the structure for cycle 5 has an obvious 5-wave look to it. Primary 3 can only subdivide as an impulse. It begins here, 1, 2, and 3 looks incomplete. When 3 is complete, again, I'll be expecting a multi-week or even multi-month pullback or consolidation for intermediate wave 4, so that it's in proportion to intermediate wave 2, so that the impulse for primary 3 has what we call the right look. And so along the way up toward this final target, that's why I'm going to be expecting 2 big pullbacks or consolidations along the way up, but I do not think we're ready for that quite yet. Intermediate 3 is unfolding as an impulse, 1, 2, 3, then we'll have 4 and 5. And you may notice here that minor wave 2 doesn't show up at the weekly chart level. It does show up quite nicely at the daily chart level. It was a quick, sharp zigzag lasting only 3 days. Sometimes zigzags can be quite quick structures. Now I know that what I just said about proportion regards primary and intermediate degree isn't adhered to here at minor degree, and this is one of the problems with analysing the S&P. It doesn't always have good proportions. Now we can expect that it should most commonly have good proportions, but sometimes it just doesn't do that. The subdivisions here of minor waves 1 and 2 fit very, very well at the daily and hourly chart level, and so that's why I'm labelling it like this at the weekly chart level. It tells us that when minor 3 is complete, minor 4 could possibly also be just as brief as minor wave 2. It might last only 3 days. But because minor 2 was a zigzag and they're quick structures, let's expect alternation for minor 4 and it to be a more time-consuming flat combination or triangle. They generally last longer. The target for minor 3 is for it to reach the most common Fibonacci ratio with minor 1 at 1.618. When minor 3 is complete, then minor 4 should unfold and last at least 3 days, probably a bit longer, maybe a Fibonacci 8 or 13, and it can't move into minor 1 price territory below 2299.55. It's very likely, though, to remain contained within this best fit channel. I'm drawing across these lows to this low here, placing a copy up on this high. This looks like where price is now coming up to find resistance. Let's take a look at the daily chart, where minute wave 3 and 4 are this high here, and this low here. And now we're looking at the final fifth wave of minute 5 to end minor 3. At the daily chart level, when it's complete, it should have an obvious 5-wave look. So far, that's developing very nicely with a short first wave, probably a flat correction here for a second wave, a regular flat, a long impulse for a third wave, which does have a Fibonacci ratio to the first wave of 4.236, not a common ratio to exhibit, but mathematically that is correctly a Fibonacci ratio. It's just 8.43 points less than this ratio to minuet wave 1. My definition of deciding whether or not the difference in a wavelength still gives it a reasonable Fibonacci ratio to another wave is if it's less than 10% the length of the wave. That's the judgment that I apply there. And here, minuet wave 3, the difference off the Fibonacci ratio to minuet wave 1 is less than 10% the length of minuet 3. So I judge that to be an adequate Fibonacci ratio between those two waves. Here, minuet 4 looks like a quick zigzag, so there's nice alternation between the flat of 2 and the zigzag of 4, and the whole thing fits really nicely in an Elliott channel. I've drawn this one using Elliott's first technique from 1 to 3 with a copy on 2. Here I expect it's the third within the third wave, it's its fifth wave, which is the stronger extension. But in this Elliott channel, within the strongest portion here, the fifth wave, it's its third wave, which has quite a good overshoot. When the S&P has third wave extensions within third wave extensions, the strongest portion of the third wave often has an overshoot of the channel, but here it's the fifth wave, which is the longer extension, so it makes a lot of sense really that if this is the strongest portion, then the third wave within it is the strongest, and here we have an overshoot of the Elliott channel. So that actually has a pretty typical look in terms of strength within this wave. So I'm really satisfied that this channel has a really good look, a good fit, and so this wave count at the daily chart level I think has the highest probability. Let's have a look now at how this final fifth wave, minuet 5, within minute 5, within minor 3, may be unfolding where it began down here. This point here, it needs to be a 5-wave structure. So far, I think it looks like it's unfolding as an impulse. We have an impulse for 1, a zigzag for 2, and now 3 should be unfolding. The Fibonacci ratio I'm applying for the target here is equality in length with subminuet 1 because it fits so well with the higher target at minor degree for minor 3 to end. Within the third wave, I think we've started out with a couple of first and second waves corrections, and now would be looking to end the third waves and move through a couple of small, short little fourth wave corrections on the way up toward the final target for subminuet 3. Within subminuet 3, if my labelling here is incorrect and a second wave correction is still to unfold, it can't move beyond the start of the movement below 2566.17. And this lower green trend line, this is my bottom line for this hourly wave count. While price remains above this trend line and within the green channel, let us continue to assume that the upward trend remains intact. If this trend line is breached by downward movement, then this is the wave count that I would use. It's all the same to this point here, and now I've simply moved the degree of labelling within this impulse here up 1 degree, and so it is possible that minor 3 could have been over here, and we're moving into a multi-day consolidation or pullback for minor 4. Now remember, minor 2 was a quick zigzag lasting only 3 days and relatively shallow, so let's expect minor 4 is likely to exhibit alternation as a flat combinational triangle. That would give it good alternation and structure, and these are all more time-consuming structures usually than zigzags, so it may last a few days, maybe a Fibonacci 5, 8, or possibly even 13. Within minor 4, if it's going to be a flat combinational triangle, the first movement should be a 3-wave structure. That may be unfolding as a flat for either minute A, which could also be relabelled as minute W if we're looking at a combination. So we'd have a 3, 3, 5 unfolding for a flat correction, the first three-wave structure for wave A or W in minor 4. Minuet B certainly could continue higher at the end of Friday's session. There's not enough downward movement to tell us that this upward wave is over. Within expanded flats, B waves do move beyond the start of A waves. The normal or most common length for a B wave within a flat is from 1 to 1.38 times the length of the A wave. But this upward movement has some strength within it. For Thursday's upward session, it had some pretty good support from volume. B waves usually exhibit weakness, not strength, and so that reduces the probability of this alternate wave count. However, after Friday's session at the end of the week, there's now some divergence between price and market breadth, indicating some reasonable weakness in this upward movement from Friday, and that hints that this alternate wave count certainly could be correct. And so if we do get price moving below this trend line, then this is the wave count I would use. I'd expect a multi-day pullback or consolidation at minor degree has likely arrived. Let's have a look at classic analysis now and see which of those hourly wave counts has more support. Last week there was what I expected was a hanging man candlestick pattern, and I warned that the bullishness of the long lower wick on a hanging man in the context of an upward trend mean that it essentially needed bearish confirmation in the next candlestick. We have not got that, and so we should not be reading this as a reversal. It clearly isn't a reversal. Price is continuing to move higher. This week's candlestick has a somewhat longer lower wick that's reasonably bullish. We see some decline in volume, slightly bearish, but volume for these 2 weeks is still heavier than these 3 weeks, and so overall volume is still increasing. That's not enough bearishness to call a high in place by any means whatsoever. On balance, volume at the weekly chart level is still very bullish. I give this one a lot of weight. This supports the main hourly Elliott wave count, and I think that's more likely. RSI is overbought, but as you can see, it can remain extreme for a reasonable period of time when the S&P has a reasonably strong bull trend. It can move further into overbought only when it exhibits clear and strong short-term divergence with price while it is overbought. Would it then be indicating enough weakness to be on the lookout for a reasonable sized pullback or consolidation? That situation is not the case here, and so we should expect the trend remains the same until proven otherwise, even though RSI is overbought. ADX also is now showing an extreme upward trend. It's above both directional lines and it's getting close to 35, which would be a very extreme trend. However, that can continue for several more weeks. Back up until this point, when I looked at this bull market on the weekly chart from the March 2009 low, and I looked at ADX, every time up prior to this point that ADX showed an extreme upward trend, it was followed by at least 2, 3 or 4 weeks of downward choppy sideways movement to relieve extreme conditions. But that wasn't what happened here. ADX was fluctuating but was still showing an extreme upward trend here and here and here for several long weeks before we got just a couple of weeks of downward movement, well, almost 3 weeks here for this little flag pattern. And so ADX, we've learned recently, can remain again extreme for reasonable periods of time, and price can continue to move on higher. So I'm not going to use this as a timing signal at this stage and say that we need a decent pullback or consolidation here. That hasn't been the case here. Let's assume it may not happen again. MACD still bullish. That is a lagging indicator. What about the short-term situation at the daily chart level? The first thing to note is this chart is very obviously very bullish. The moving averages are very bullish. The short-term Fibonacci 13-day average is positively sloped. It's above the mid-term Fibonacci 55-day average, which is also positively sloped. And they are both well above the 200-day moving average, which also still has a positive slope, and price is above all three. That is a full-bore bullish look. When we have these pullbacks or consolidations, price is managing almost always, not always, to close above the short-term Fibonacci 13-day moving average. And so this is the other bottom line I have. I've got that green trend channel on my first hourly chart. While price remains within that channel, assume the upward trend remains intact. And I also want to use this Fibonacci short-term 13-day moving average as my other bottom line. While price keeps closing above this, assume that the upward trend remains intact. There's pretty obviously a bull market. Now, if we continue to assume that that remains intact until proven otherwise, then our trades should be profitable until the last one at the end when price finally turns, and then we can exit long positions. So you may have a loss for the final one, but prior to that, we should have just profits, and we should be using pullbacks and consolidations to join the upward trend. That's just a simple, logical approach to this market. Friday's upward day has made very slightly a new all-time high, a bit of a long lower wick, that's bullish. Some decline in volume, though, tells us that the upward movement for Friday doesn't have good support from volume, so now normally that would be reasonably suspicious, but we've noticed that for this bull market we are seeing these signs of weakness, and yet price can continue to move on up. Now let's put this in the bigger picture. My bigger picture for the Elliott wave count sees this upward bull market as a fifth wave at cycle and super cycle degree. So nearing the end of that, we absolutely would be starting to see some reasonable signs of weakness. Those weakness signs should develop and persist for quite a while before we finally get the high in place. I think that's, like I said before, at least 4 months and maybe 1, 2 or 3 years away. And this is what I mean by some signs of weakness. We have rising price on sometimes declining volume. It happened here, and here, and here for several days, and yet price just keeps on rising. Now that can most certainly continue to happen again. This most recently has not been a good timing tool. So there's weakness, but price keeps on rising. ADX tells us there's weakness. It's still declining even though price is rising. It's telling us there's no clear trend, but pretty obviously there is actually an upward trend. ATR is showing a little bit of strength. For these days, price is able to the bulls are able to push price higher and make new all-time highs, and they're able to do it by an increasing range each day. So there is some strength to this upward movement. On balance volume is one of the few indicators I've noticed in recent weeks or months that does remain one of the more reliable indicators, and so I am going to continue to give this quite a lot of weight. At this stage, on balance volume is very bullish. This offers support to the main hourly Elliott wave count. Divergence between price and RSI recently has proven to be less reliable. Up until this point we had double bearish divergence. Now we've only got single bearish divergence, so it's not showing as much weakness. There is still weakness there. This market is susceptible to pullbacks. That alternate wave count is possible. It's a warning for long positions, but we should still assume the trend remains the same until proven otherwise. Double bearish divergence between price and stochastics also warns of weakness within this upward movement. Now approaching the end of a third wave and the fifth wave of a third wave, that's absolutely what we'll expect to see. MACD still bearish, it is a lagging indicator. Bollinger Band still tightly contracted. There isn't a lot of volatility in this market. What about inverted VIX and the AD line? We had a bullish signal here from inverted VIX. Price made a lower low and a lower high. It moved lower, but inverted VIX moved higher. So the downward move in price did not come with a normal increase in market volatility. It came with a decline in volatility that was bullish. Now we've got an upward day, so that was expected. And now that there is no divergence now between price and inverted VIX. The rise in price for Friday has come with a normal corresponding decline in market volatility. This is bullish and supports the rise in price, or at least isn't telling us there's anything wrong with it in terms of volatility. We have, though, a bearish signal from price in the AD line. Price has made a new high, a new all-time high, with a higher high and a higher low, and it's closed green or white. That's upward movement. But the AD line for Friday has very slightly declined. The rise in price for Friday did not come with a normal corresponding rise in market breadth. Breadth is weak. This is a bearish signal, and I'm going to give this some weight. I'm going to say that that alternate hourly Elliott wave count, there are warning signs that it could be right, but again, assume the trend remains the same until proven otherwise. I want to see that trend channel on my hourly chart breached before I take that alternate too seriously. There is also some weakness within the market. Small and mid caps for Friday have failed to make all-time highs. It's only the large caps for Friday that were leading this advance in price. So there's a little bit of weakness beginning to develop. Now again, approaching the end of that minor wave 3, that's exactly what we'd expect to see. That's all from me at the end of the trading week with your video update, and I hope all our members and viewers are having a most fabulous weekend.